In this chapter, we will look at fixed exchange rates versus floating exchange rate regimes. We look at the pros and cons, the advantages and disadvantages, the costs and benefits, as it were, of a fixed versus a floating exchange rate regime. And this may help us to understand the rationale for countries to choose either one of those regimes. So, some of the basic questions that we like to ask ourselves is, why do some countries choose to fix? So, fix is also called a pegged exchange rate, or PEG, PEG, and others adopting a floating exchange rate regime. Why then is it the case that sometimes countries do change from one regime to another? This is a very important set of questions that is being asked in international macroeconomics. And we look at the pros and cons of different exchange rate regimes. You can see here that there has been a lot of variation, both cross-sectionally as well as over time. So cross-sectionally means that at a specific point in time, say around the 2000s, you have some countries that are floating, some countries adopting a peg, and a peg is a fixed exchange rate regime, and often this is a bilateral peg. The country pegs its exchange rate to, for instance, the US dollar, or the German mark, or the French franc, or some other currency. So cross-sectionally, you have a, if you like, variety of exchange rate arrangements. Then at the same time, also in terms of time series, so looking over time, it is the case that, for instance, countries in the euro, what will become the euro area, preceding the introduction of the euro, were pegging, for example, to the French franc or the German mark, and then over time switched to pegging to the euro. Or countries pegging to the British pound, and with the continued decline of the former British Empire, the role of the British pound, at least in international fixed exchange rate arrangements, also declined, while the role of the US dollar rose. And these have interesting implications also for the future of international finance as well as the international monetary system, with the rise of China as well as the continued internationalization of the renminbi. So you can also see in this chart that from 1870 to 1913, the dominant regime was the gold standard, and subsequently this gold standard was suspended and it was resumed in the late 1920s. The gold standard is a type of fixed exchange rate regime whereby a country currency is exchanged at a fixed ratio relative to gold. And then when you have, for instance, two countries fixing the exchange rate to gold, then you can calculate the implied exchange rate by calculating the, for example, country 1 rate of exchange to gold, then country 2 rate of exchange to gold, and then see how much you can get from one country's currency once you convert it via gold into the other currency. Now, after World War II, over time, the gold standard was dropped. And then in the 1970s, countries adopted a floating exchange rate regime. Now, we can ask, what is the best type of exchange rate regime for a country at a specific time? Now we look at the pros and cons, starting with a application to Germany and Britain. So this case study is about the UK deciding to switch away from a peg to a floating exchange rate arrangement at the end of 1992. And at that time, there was a push for a euro, the common currency in the euro area. And the first step towards that result was the ERM, a exchange rate mechanism that was created earlier in 1979. That was the predecessor of what would later become the euro area. The German mark, or DM, Deutsche Mark, is the base currency or the center currency in this fixed exchange rate system, and other countries fix their exchange rate relative to this base currency. In the following, we will use the ISLM model. I, S standing for investment saving, L, M standing for liquidity, demand, and money supply. And it will be assumed that the ISLM model is common knowledge. The basic ISLM model is extended to the ISLM-X model, which includes imports and exports in the open economy. And the Feenstra-Taylor textbook has an extensive chapter dedicated completely to revising this basic material, which is covered or should be covered in introductory economics or introductory macroeconomics. So please review that material now if you are unfamiliar with the ISLM X model. Now, we have three diagrams. We focus on the first, the German ISLM diagram. It has the interest rate on the vertical axis and output on the horizontal axis. Now, let's start with reviewing the IS curve. As I mentioned previously, IS stands for investments and saving. And investment and saving schedule or curve represents the equilibrium in the goods market, in the market for goods. Investment represents the demand for goods, and savings represents the supply of goods left over after production is being consumed and otherwise used. What is not being consumed is saved. So think about it this way, that what is being produced and not consumed is saved. Think about an economy which just produces, for instance, rice or seeds, or let's say wheat. Um, and if we stick to the rice example, if the economy is producing merely rice, some of the rice, let's say 100 pieces of rice, if 70% are consumed, and we assume for now a closed economy, just to make it simple, 30 are left over to be uh, invested. And if the investment demand, the demand for these leftover goods, is equal to the supply of it, saving, then we have an equilibrium in the goods market. You have 100 rice units of rice being totally produced, 70 goes to consumption, and the rest is soaked up by investment. And this represents the equilibrium in the goods market. And for this is just a review, and you should understand this. If you do need a refresher, I suggest strongly that you now at least go back to the chapter in the Vincent Taylor textbook that reviews this, or your basic econ introductory textbook. Now, then we proceed to derive why the IS curve is sloping downwards. To derive the slope in the IS curve, we have a change in R, or in this case, we call the interest rate I. So let's call it the interest rate I. And let there be a change in I. So when there's an interest rate change, what is the effect on Y? And when the interest rate is higher or lower, what is the effect on Y? Now, when the interest rate, for instance, let's say we start from a point here, is lower, then Y is higher, and that is due to the investment channel. The lower the interest rate, the higher the demand for investment, therefore the higher the output needs to be for the equilibrium to remain in the goods market. LM stands for liquidity, demand, and money supply. Let me separate these two. So in red, liquidity is representing the demand for money, and M is representing the supply of money. And we have an equilibrium in the market for, as you probably can guess already, the market for money. And how we derive that function, why it is sloping upwards, is a change in y leads to what subsequent change in the interest rate for the market for money to remain in equilibrium. So we start with a change in y, because when there's a change in y, when you go back to the money demand, money supply diagram, when there's a higher income level, you have a higher level of demand for money, and there's a shift in that diagram in the background. And I would like you to review that if you are not familiar with the logic and the economic rationale I am elaborating here. So note that we start with I in the IS curve and Y for the LM curve to derive the slope of the LM curve. This is in line with economic rationale and how we build it up, how we build up the IS curve and the LM curve. So when you have an increase, for instance, Let's pick, for instance, this LM2. If we have an increase in income, there is a higher demand for money. If the supply of money is left unchanged, there will be excess demand for money. To stave off, to reduce, to eliminate the excess demand for money, you increase the cost of holding money, which is the opportunity cost of holding money, which is the interest rate. Therefore, the interest rate needs to rise to keep the market for money in equilibrium. So this is a 7-minute brief, concise review of the basic ISLM model. And if you haven't reviewed it, I strongly suggest that you do review it at least now. So here we start the analysis, having completed the review of the ISLM model. Now, first, we have the ISLM intersecting at point 1. And then what happens is the government increases spending after German reunification, and the IS curve shifts out from IS1 to IS2. And then the central bank, Bundesbank, tightens monetary policy to stabilize output. And the LM curve shifts in. And the result is that interest rates are higher at I2, while output is kept at Y1. So the interest rate rising, then we go to panel C, the British FX market, to see what effect this has on the exchange rate. First, we have DR and FR, and DR is simply the domestic return. The domestic return is simply the interest rate. And FR is the foreign return. So when we start with the blue lines, which is the initial setup, we are at the exchange rate E bar. The foreign return is downward sloping. And note, and I refer you to the book to derive why the foreign return is downward sloping in detail. This is relating to UIP, to uncovered interest parity. So if you recall UIP, it is defined as the domestic interest rate equals the foreign interest rate plus the expected rate of depreciation, which is E t plus 1 minus the current exchange rate. So the term on the right-hand side is the expected rate of depreciation. And this is the formulation for the foreign return. It shows that when there's an increase in the exchange rate, do this in green, when there's an increase in the exchange rate, for UIP to remain equal, there must be so on the right-hand side, there's a fall of the right-hand side. And in order for UIP to remain true, the left-hand side also needs to fall. So if the right-hand side falls of UIP, the left-hand side needs to fall. because we mentioned that UIP is the equilibrium condition in the foreign exchange market in the short run. And this is defining the FR curve, the foreign return curve. So if you like, another way to look at this is the following. The left-hand side of UIP is the domestic return. The right-hand side of this equation is the foreign return. What you get from investing your funds abroad and converting them from your home currency into the foreign currency using ET, the exchange rate at time t. And then once you got the interest rate I star, then you convert it back at t plus 1 using the exchange rate in the future to convert it back into your home currency. And this is the foreign return. And the foreign return needs to be equal to the domestic return, the left-hand side, for UIP to be true and for there to be no arbitrage in the foreign exchange market. So if we depict the DR curve on the FX diagram, it's just a horizontal line. If we depict the FR, the right-hand side, we have a downward sloping line. And that is, if you like, how you derive the equilibrium in the FX market, the DR curve and the FR curve. So we derived that in the foreign market, and we view it from the UK perspective, that there's an increase in I star. So this is the foreign interest rate, and I star is the foreign return. So FR shifts up from FR1 to FR2. And if DR is left unchanged, we would go from 0.1 to 0.4. The exchange rate will increase. But under the fixed exchange rate regime, the exchange rate needs to be maintained and pegged at E bar. So the only option left to the UK policymaker is to increase the domestic return. And if the domestic return is increased, then we are back at the pegged exchange rate E bar. And how that is done is depicted in panel B. Increase in the foreign interest rate shifts out the home IS curve. And to maintain the fixed exchange rate, home LM must shift from LM1 to LM2. And any other LM curves would imply depreciation. And with the same exchange rate E, a higher interest rate, demand and output must fall. And Britain suffers a recession because of some macroeconomic developments in Germany, in the country which it is pegging its exchange rate to. And this highlights some of the costs or disadvantages of pegging your exchange rate for the country which is pegging. And this is highlighted here, that there's an output loss, a reduction in GDP for Britain. We have seen that the UK experienced a recession, although this was triggered by a policy response in the UK to macroeconomic events in Germany, to the country which the UK was pegging its currency to. Now, the government then in 1992, September, decided that the benefits of being in the ERM were smaller than the costs. And then UK opted out of the ERM, the exchange rate mechanism. And Britain never joined the euro area. So it never adopted the euro. It kept its pound. Now, we can ask if Britain made the right choice. And then we can compare it with France, another country that maintained its peg to the effectively the German mark, and compare the macroeconomic performance between the two countries, France and UK. So you can see here interest rates, exchange rate movements, and real GDP growth. And you can see that the exchange rate movements in the UK, the pound to mark, were much larger than the French franc to the mark. So it allowed the dropping out of the ERM allowed the UK to effectively float against the mark, while France was relatively stable in its exchange rate relative to the mark. And Britain had a higher real GDP growth relative to France. Now, naturally, while this is suggestive evidence, it is far from conclusive because there's a lot of other factors that are feeding into real GDP growth other than the exchange rate. So it's not conclusive evidence that therefore Britain made the right choice or not. It's one of many factors that a country can choose to manipulate in its policy toolbox, but it's again just one of many. So for that, we still need to delve deeper into the subject to understand the choices of a country when deciding to have a fixed exchange rate or a floating exchange rate. So something that is very important in deciding to adopt a fixed exchange rate are two factors: the level of economic integration and the level of symmetry or similarity of shocks facing the country. The higher the economic integration and the higher the similarity of the economy, the better suited two countries are or two economic areas are to having the same exchange rate. And that will be seen in the following. The economic integration term is defined as the linkages in markets across goods markets, capital markets, and labor markets across an economic region or country. And the higher the two regions are economically integrated, the greater it makes, if you like, the greater benefit the two countries can derive from having a common currency, or that is could be either a common currency or a currency or two currencies that are closely linked to each other via a peg. So as integration rises, the efficiency benefits of a fixed exchange rate increases because there's less waste in transaction costs needed when you have two currencies or currencies that are fluctuating against each other. So secondly, when we come to the other factor, economic similarity, the greater the symmetry of shocks, the more beneficial is it that the two countries essentially have to respond in a similar way to the shock. So if you have two countries, if they have the same currency, essentially they have the same interest rate, which suggests that they have the same monetary policy. The same monetary policy applied to two countries is fine if the two countries are observing a business cycle that is symmetrical. So when the business cycle is going up in one country and then subsequently going down, The other country has a business cycle that is similar, that has an upward swing and then followed by a downward swing, where you have interest rates that are being increased at a time of a business cycle upswing and interest rates being decreased when you have a business cycle downswing. And let's say this is time. And for instance, this would be, let's say, GDP. So it makes sense then to have a common monetary policy if there is symmetric type of shocks in the symmetrical business cycle. The opposite is the case when you have asymmetric shocks. Then you have costs in terms of lost output when monetary policy doesn't really align well across the two countries. So this summarizes the point that the greater the similarity of the business cycles and the shocks that are driving those business cycles, the greater the rationale to have the same currency or a currency that is pegged to another currency. So as economic similarity rises, the stability costs of fixed exchange rates decreases. Stability cost here means that you might have more instability if monetary policy is not very well aligned across two economic areas. So this is a graphical depiction of what we have mentioned previously. The higher the symmetry of shocks, the more it makes sense to have a fixed exchange rate, which is denoted here, shaded in red. And the higher market integration, the higher the reason to adopt a fixed exchange rate. And naturally, neighborhoods within a city are both exposed to symmetrical shocks or similar shocks. Say, for example, if it rains there, then in one neighborhood, it rains in another neighborhood. Market integration means that they have a lot of trade with each other. So the more closely integrated and the more symmetrical, the more it makes sense for them to have a fixed exchange rate. And on the other, if you like, other end of the spectrum, you have poorly integrated or dissimilar countries where it doesn't make sense from an economic theoretical point of view at that time to adopt a fixed exchange rate. And then in between, you have intermediate cases where it's more questionable whether or not the benefits outweigh the costs of adopting a fixed exchange rate. So, one of the arguments in favor of adopting a fixed exchange rate is that it will improve the level of trade between two countries because the transaction costs are lower due to a stable exchange rate or the same currency. In terms of the gold standard, it seems to be the case that the gold standard was associated with an improvement in bilateral trade between 30 and 100%. And we can then look at if today's fixed exchange rate had also a positive effect on bilateral trade. Now, again, note from an econometric point of view, correlation does not imply necessarily causation. So if something is associated with another factor, there could be a third cofactor, a third variable, a variable that we're not considering, driving both results, both the adoption of the gold standard as well as the higher level of bilateral trade. And that is something to bear in mind. Some omitted variable bias, which is a common theme from econometrics when we look at empirical data. This caveat borne in mind, we proceed to look at fixed exchange rates and the impact on bilateral trade. So here we look at the exchange rate regime by indirect peg, direct peg, and the currency union type, and the volume of trade relative to a floating regime. And you can see that a currency union, countries in a currency union exhibit more trade relative to a float, and similarly a direct peg. So countries that have a fixed exchange rate, a direct peg, exhibit also a higher level of trade relative to a floating exchange rate regime. Now, again, as I mentioned previously, it could be also vice versa, that actually the large volume of trade is predisposing countries to join a currency union. So the causality could run the other way around, that you adopt a currency union, in particular, if you have a high volume of trade, which is what we talked about in the symmetry of shocks and market integration diagram. And as the market integration and volume of trade is lower, but still high, you might want to adopt a direct peg so that the volume of trade is still higher relative to a floating exchange rate regime. So, in essence, this figure should be read with a grain of salt. I'm aware that the textbook interprets this figure slightly differently, but I would like to caution to interpret this as a causal result, that a currency union leads to more trade because it has to be in what they call in econometrics an exogenous factor. So the adoption of the currency union is not independent of the existing volume of trade. In other words, if a country is near the euro area, you might like to join even more as a country if you have extremely high volume of trade. But if you have low volume of trade, maybe you're happy to do a direct peg rather than join the currency union in a fully fledged manner. Next, we can look at the efficiency that fixed exchange rate may contribute to. And you can measure this by price convergence, either of one good, low of one price, or a basket of goods in terms of PVP. So if there's more trade once a fixed exchange rate takes place, then any differentials in prices should be smaller once there's a greater market and countries' markets are exposed to more international competition from abroad, so that you should see prices converge. When a country pegs its exchange rate, it gives up its monetary policy in terms of its independence because it has to keep the interest rate domestically such that UIP continues to hold. So if you just imagine UIP as we've drawn it previously, left-hand side, domestic interest rate, the right-hand side, foreign interest rate plus expected depreciation. So this is UIP. The expected change in the exchange rate, the expected depreciation, this should be equal to 0 under a fixed exchange rate, because you shouldn't be expecting the exchange rate to change, which suggests that the interest rate abroad is equal to the interest rate at home, such that your monetary autonomy is foregone. You have to set your interest rate as a country to the interest rate abroad. So you give up autonomy or dependence of your monetary policy. This puts countries in a trilemma. They cannot have their cake and eat it too. This is an English expression, to have your cake and eat it too. Which means that you have to choose between a rock and a hard place. Or to use Greek mythology, you're facing Scylla and Charybdis, for those of you who have been schooled in Greek mythology, and these expressions are common in the English language. So what this means is a trilemma. You have to choose. You cannot have everything all at once. Trilemma here means you can choose two things, but not all three. You have to give up one. And this is the triangle of the trilemma. When you choose open capital markets with fixed exchange rates, or you choose open capital markets and a float, so you have to give up the fixed exchange rate, or you opt to close capital markets. And this trilemma we can see concretely, visually, in the trilemma triangle. So if you look at the left-hand side, the open and pegged country, open here means open capital markets and pegged fixed exchange rate, means that basically the change in the base country interest rate is almost exactly equal to the change in the own interest rate, where the red line is equal to the black line. The black line is the 45-degree line. So if you have open capital markets and a fixed exchange rate, monetary policy is foregone, because the interest rate cannot deviate very much from your base country interest rate. When you go all the way to the opposite, where you have closed capital markets, you have a gap between the 45-degree line, which means a one-on-one change in own interest rate relative to foreign base country interest rate. And the red line is the fit with the data in green. It shows that actually the red line can deviate substantially from the black line, suggesting that you have to close capital markets to maintain your monetary policy autonomy. So in other words, if you have open capital markets and a fixed exchange rate, this implies that your monetary policy autonomy is foregone, which means that if you have a GDP rise or fall more than what you like to have, so either the economy is overheating or falling off a cliff, so that recessions are longer and deeper, and booms are, if you like, more severe and longer lasting than you would like to have the economic boom, it means that you have a Y, GDP, the variable Y, fluctuating more than what might be optimal from a welfare perspective. So this is called the cost of fixing your exchange rate by measuring output volatility. Here you can see the change in home country real GDP growth rate when base country interest rate rises by 1%. And you can see that for developing countries and emerging markets, the output costs are smaller than developed countries. So it suggests that for emerging countries, emerging markets, and developed countries, fixing the exchange rate actually does not involve as much output volatility cost as it does for developed markets. This is important empirical fact to bear in mind when the argument is made that one can read occasionally in the financial press or academic literature that it is emerging markets that should adopt a fixed exchange rate, whereas this data suggests that the output costs of fixing are actually less than for developing countries and emerging markets than for developed countries, that is the advanced countries, by a measure of or a factor of 2, 0.27% versus 0.12%. So one argument in favor of adopting a fixed exchange rate is that sometimes countries that have a floating exchange rate can use their central bank to print a lot of money and then to create inflation. And by creating inflation, the real servicing cost of debt falls. So this is called monetizing the government deficit or debt. When the central bank is printing money in response to government debt being issued, so with a specific aim at creating inflation to inflate away the debt. So when you have debt, let's say $100, and your income is $100, you have to give up 1 month's income to service that debt. Now, if prices rise and your income rises, prices rise and income rises by the same amount. Prices rise by 10%, your income rises by 10%. Your income is 110. You can still buy one bundle of goods, but now it's easier for you to pay down the debt because the debt is, it tends to be at least, denominated in nominal terms, $100, other than if it is inflation linked or indexed debt, which is very rare. So if you have inflation, the government can pay back the debt more easily if the central bank specifically tries to raise inflation and thereby monetize the debt. And the government thereby can obtain some benefit, which is called seigniorage. It's a kind of an inflation tax. Inflation tax here means you create inflation and you basically tax the debt holders as well as holders of wealth who have wealth held in the form of money. And the fixed exchange rate may help to counter this tendency to monetize the debt. This is called imposing fiscal discipline. So that is restricting the government from issuing debt and borrowing by not allowing it to pressure the central bank to create inflation by printing money. Printing money here is a figurative term. Money is no longer printed in that sense in quantitatively significant terms, but this printing press is digital these days. So it's a figure of speech. So here you see the inflation performance by exchange rate regime. You can see in column 1 of countries in the whole world, regardless of country type, the freely floating relative to the freely falling have a marked difference in the inflation performance. The inflation is extremely high in the freely falling relative to the freely floating. And if you then compare freely floating to fixed, you can see that the fixed exchange rate regimes have a higher inflation rate. Now, if you go to advanced countries, the difference is rather marginal between the freely floating and the fixed exchange rate regime. So the freely falling ones are typically countries that are in some sort of a crisis. So you can take these, if you like, as separate. It's good to take these countries which are in exchange rate crisis, which we will look at in the subsequent lecture, as a little bit as a different kettle of fish. Now, then, if you look at the emerging markets and developing countries, you can see that the freely floating countries actually have a higher inflation rate than the fixed regime types. Then, if you look at emerging markets and developing countries, excluding the year after the regime change, then you can see that the fixed exchange rate regime actually has a better inflation performance than the freely floating. So it suggests, and this is quite a remarkable result, which chimes with the earlier empirical evidence that it seems to be the case for emerging countries and developing countries, a fixed exchange rate regime has actually a lower inflation rate. And we've seen this also that the output volatility costs of a fixed exchange rate are less for developing countries and emerging markets. Whereas the long held consensus that is since been overturned, at least with these data, is that emerging markets should rather adopt or eventually adopt a freely floating exchange rate regime. But these recent data seem to suggest that fixed exchange rate regimes seem to be relatively, at least on these performance indicators, suitable for emerging markets in developing countries on average. It does not mean that this holds true for all countries. Nonetheless, it is an important empirical finding to bear in mind when assessing the suitability of a floating exchange rate regime for for developing countries or emerging markets. So wealth is measured as net assets. Net assets is gross assets minus liabilities, which is equal to net assets. And assets of a country are assets at home, AH, and assets abroad, AF. And the assets abroad need to be converted into the currency of the home country using the exchange rate E, which is denoted here. And on the right hand side, you also have liabilities, and then the liabilities abroad, foreign liabilities, also need to be, if you like, accounted for in the domestic currency using the exchange rate. Now, a small change in the exchange rate, ceteris paribus, other things being equal, affects the value of these external assets and the external liabilities, and we can express the resulting change in equation 8.1. That is the exchange rate change as well as the change in the net international credit or debtor position in dollars. And this depends on whether or not a country is a net debtor or a net borrower. So you can imagine a model that shows you how wealth affects the demand for goods. And what these following slides are trying to show is that if you have shocks to wealth, it will affect demand in the economy, and this undermines the welfare of a country. And to tease this out of the model, we assume that consumption is a function of disposable income, C open parentheses Y minus T, disposable income as well as total wealth. So not just your disposable income, but also your wealth that is available. And then firms find it easier to borrow when they have a higher net worth measured by their wealth. And the investment function is a function of the total wealth as well as the interest rate. So if foreign currency external assets are higher than or lower than foreign currency external liabilities, the country has a currency mismatch. So what this means is that if you borrow currency in one currency and you lend in the same currency, but the amount of lending and borrow is not the same, it means that you have a currency mismatch to the extent that if you borrow, let's say, in US dollars as a European, and you borrow and lend in dollars as a European, and let's say if you borrow $1 and you lend $1, then an exchange rate change will have the same effect on your asset and liability side. So your wealth in terms of net assets will not change, other things being equal. However, if you have a currency mismatch, which means you are borrowing, let's say, more in dollars than you are lending, an exchange rate change will have a positive or negative impact on your wealth. So, for instance, if you have a net asset position in your foreign currency, net assets, so where assets are exceeding liabilities, when the exchange rate depreciates, it means that your home country, if you like, currency falls. This means that your foreign currency appreciates. So the foreign currency becomes more valuable. Now, if your assets in foreign currency are higher than your foreign currency liabilities, and the foreign currency appreciates, equivalent to your exchange rate, your domestic currency depreciating and losing value, this is an increase in wealth for the country. And vice versa for a country where liabilities are exceeding assets, where a depreciation again will lead, however, this time to a fall in wealth. And it can be the case that if these valuations effects are large enough, the total effect of a depreciation can be contractionary. So what this means is typically, if you recall the ISLM model, a depreciation of a country will typically lead to exports rising. And if exports rise, it has the effect that other things being equal, that output also increases. However, if you have these valuation effects, and if these are large, and if wealth falls, it could be the case that demand falls and consumption falls. And if consumption falls, output can fall. So if these valuation effects Valuation effects here mean the exchange rate effect passing through to a country which has a currency mismatch. Then the exchange rate depreciation in our model is, on our notation, is a increase in the exchange rate. It could actually lead to a total or overall negative effect on output, although exports would be stimulated, and this would have a positive effect on output. So these are the different mechanisms that are active in an open economy. On the one hand, you have a stimulatory effect via consumption, a negative effect via consumption, and a stimulatory effect via exports. But if the valuation effects exceed the export channel, then output can fall and you have a contraction following a exchange rate depreciation. So here you can see the exchange rate depreciations and changes in wealth, and you can see this for a number of countries. And this is in percent of GDP. So even in this chart, the seemingly small change in Korea from a exchange rate depreciation is relatively large, 4%. And then it goes all the way to more than 30% with Indonesia, Thailand, which have been hit by the 1997-8 Asian financial crisis. So these valuation effects can be extremely large, dependent upon a country being, if you like, in currency mismatch in terms of its external asset and liability position. So here is foreign currency denominated debt and the cost of crises. So the wealth loss on net foreign currency debt due to the exchange rate change in percent is depicted on the horizontal axis. On the vertical axis is the change in real output during the crisis. The change in real output is falling heavier, and this is the, if this is 0%, the higher the wealth loss on net foreign currency debt due to the exchange rate change, which means that the worse your currency mismatch, the higher the change in real output. So the higher your currency mismatch, and therefore the resultant wealth loss in net foreign currency debt, which also has to do with the size of the exchange rate change, the higher the change in real output during the crisis. Naturally, you can also argue that this is a correlation, not a causation, and when you use this caveat, you have to explain what other factor, what omitted variable might be driving the result. It's not sufficient to just merely say it is seemingly correlation and doesn't prove causation. You have to offer an alternative explanation, not just make the criticism. So if one makes this criticism that the change in real output during the crisis is higher, the higher the wealth loss, it could be the case that there is a third factor, a third variable that explains both the left hand side, the change in real output during the crisis, and the right hand side, or the x axis, the wealth loss in net foreign currency debt due to exchange rate change. So it could be the case that a country has some underlying weakness, some structural weakness, perhaps some political economy factors that would expose it to not being able to borrow in its own currency. So it has to borrow in another currency. So if you borrow in your own currency, you have no currency mismatch. But if you have to borrow another currency, not in your home currency, then it might be the case. And if you have no external assets, then essentially you have just liabilities, or liabilities being greater than assets, such that the country has a large wealth loss on net foreign currency debt. And if these underlying structural weaknesses, macroeconomic weaknesses, policy weaknesses, political instability, governance issues, etc., they might also lead that country be subject to more flighty capital flows, which, when they leave the country, will expose the country to a larger exchange rate change. All of which leads to, number one, the observation of higher wealth loss on net foreign currency debt. And the structural weakness in the macroeconomic, if you like, factors that explain the first factor might then also explain that once a country hits a crisis, be it sparked or triggered by a banking crisis or by a, if you like, foreign exchange rate crisis, could also then explain the second factor, the second observation, the second data point, that these countries might fare worse during a crisis in terms of real output decline. So it could be that there's a third factor, or more than three, if you like, more than three factors at play, a third variable, or several other variables that are driving the observation one and two. This is the so-called omitted variable bias, that there's something that could be driving both data points. And this is a general point in econometrics, but it is important to keep in mind because in international economics, we do look at a lot of charts and data, as our study of international economics and finance has always, throughout the course, been very closely linked to the real world. However, the data and the case studies, although they are taken from the real world, they have to be always taken with a pinch of salt, and one has to exert critical judgment when reading charts and data to ensure that the methodology and the rationale by which the conclusions are reached are valid. So the idea of original sin here is that some countries, in particular poor developing countries, are unable to borrow in their own currency from abroad. This is so-called a original sin, which means that the country's inability to borrow in its own currency. The term here could be interpreted in two ways. It could either be that the country has an innate ability due to its own inaptitude to manage its macroeconomy, and therefore it is unable to borrow in its own currency, and therefore it is exposing itself to currency mismatch because it has to borrow. Borrow creates a liability in a foreign currency. The original sin could be, this is the typical interpretation and the most common orthodox interpretation of original sin in international finance. However, you can also read it and make a case to say that the original sin could also be that despite sound macroeconomic fundamentals, the status of a developing country in the world financial system is such that it is unable, due to its, relatively speaking, immature financial markets, to borrow in its own currency. So, despite having good macroeconomic fundamentals, there might not be enough trust from the foreign investor community to be able for the country to borrow in its own currency. So the original sin here is not necessarily this is the second interpretation, uh, a doing of the country, but rather a sin or fault of the international financial system. So these two different interpretations of original sin, and I think the textbook takes the former rather than the latter, that is the first rather than the second, would suggest that the blame is put at the feet of the developing countries and the emerging markets when they experience a exchange rate crisis and a large net welfare loss and wealth loss on its external assets when there's an exchange rate crisis. The second interpretation puts the onus and the blame more on the international financial system and less on the developing countries. And if you see in the third bullet point, it says the domestic currency debts were frequently diluted in real value by periods of high inflation. Creditors were unwilling to hold such debt, obstructing the development of a domestic currency bond market. Creditors were then willing to lend only in foreign currency, that is, to hold debt that promised a more stable long-term value. So if you read this closely, you can see that the textbook's author, Fence and Taylor, take the first interpretation, the first side in this long-standing and long-running argument in international finance, namely that the poor macroeconomic management, be it by ineptitude or by a real, if you like, inability in the country to manage their economy due to civil war or some other conflicts, led to periods of high inflation, and therefore the inability to borrow in their own currency, which creates, again, external liabilities that are not denominated in your own currency. Therefore, it exposes you to fluctuations in your wealth due to exchange rate changes. This is this is the reasoning, the rationale, is due to the country itself rather than the international financial system that has a bias against developing or emerging markets. So therefore, when you then later see exchange rate crises shattering the economies, for example, in developing markets or emerging markets, the original sin here, the original reason or the original wrongdoing that is the deeper structural cause of this exchange rate crisis and the subsequent deterioration in GDP and unemployment and social instability is the doing of the countries themselves, the developing countries themselves and their situations, rather than the international financial system. In the academic literature, there is a alternative literature that offers a second view and explanation of international financial crises and exchange rate crises, other than this interpretation of original sin. But the textbook advances this, and we can analyze this reasoning. This is a measure of the external liabilities denominated in a foreign currency. So it is ideal for a country to borrow in its own currency because it doesn't have any exchange rate risk. So imagine you borrow from a bank and your income is in renminbi. And let's say if you are Chinese or you work in China and your income is in renminbi. If you borrow from a Chinese bank, you have to pay it back in renminbi. So if the exchange rate fluctuates, dollar, renminbi, it doesn't affect you. You have no risk. in that, no price risk, no volatility risk. But if you borrow in a foreign currency, let's say in, if you like, in Korean won, Thai baht, or US dollar, and then the exchange rate fluctuates, you are exposed to this exchange rate fluctuation passing through to you. It might be the case that you are able to more easily pay down your debt, or it might be that you are less able to pay down your debt, depending on if the exchange rate appreciates or depreciates in your favor or against your position. So if we look at financial centers, which have very developed financial markets, the US, UK, Switzerland, Japan, they have a very low share of foreign currency borrowing. Latin American, Caribbean countries have the opposite. They have all of their borrowing in foreign currency, and this exposes them to extremely large exchange rate risks. Now, you can ask yourself, well, if there's an exchange rate risk, the risk can be positive and negative. So it can go in your favor as well as against you, depending on appreciation or depreciation. However, it tends to be the case, viewed from the country's perspective, that there is a depreciation, which means your home currency loses value. You create GDP as a country, and you have to convert your GDP, your income, into the foreign currency to pay the foreigners, the foreign bondholders, the foreign investors in their currency, let's say US dollar. And if you have a depreciation in your home currency, it means that previously what cost you maybe 1 year's worth of GDP to pay down some foreign bondholders, if you have depreciation now, it might cost you 1.5 or 2 times annual GDP to pay down your debt. And it typically tends to be a depreciation rather than appreciation, because in situations of a banking crisis and economic downturn, foreign investors as well as local investors take their money abroad. When that happens, the investors would like to sell their home currency, that is the currency of your home country, and want to convert it into some foreign currency. If a lot of people want to sell any good, the price will fall. So the price falling means that the value of that thing is lower. In foreign exchange terms, the value of the currency being lower means a depreciation. So it tends to be that when you have, if you like, the foreign currency mismatch, that it tends to be the case that this tends to go into the depreciation territory rather than having a positive upset and having a sudden appreciation and then finding that your debt is more easily payable. So that explains why the foreign currency mismatch typically tends to be associated as a negative risk and tends to go against the country which is borrowing in foreign currency. So there's countries like Mexico, Brazil, Colombia, Uruguay that have recently been able to issue some debt in their own currency. And a more feasible and perhaps other alternative is for developing markets to minimize their valuation effects by limiting, or I feel like, the movement of the exchange rate by use of a peg or fixed exchange rate. So it suggests that there's additional reason other than the reasons that were mentioned previously, such as the relatively smaller output volatility costs that we looked at, that lend themselves to support the argument that developing countries and emerging markets might have some more reason to adopt a fixed exchange rate relative to developed markets. So in that case, the peg, if you like, exchange rate being fixed, might serve as a nominal anchor, which we have seen before, and this could be the method by which external wealth fluctuations could be managed. And these countries might have a fear of floating because they would anticipate large valuation effects once they float if capital flight is taking place once they float. So fixed exchange rate regimes have several countries, and now we have a brief review of some of the aspects of international monetary history. And one such fixed exchange rate system was the Bretton Woods system in the 1950s and 60s, and then later the European ERM. Now, these systems were based on reserve currency systems where you have capital N countries, 1, 2 until N, and one of the countries is the center country, the nth country. And this country tends to have a privilege or advantage, which we will see next. The center country has a monetary policy that is autonomous and it can do whatever it wants with its interest rate. So that's it, if you like, it's called the exorbitant privilege. The exorbitant privilege. The other non center countries that are pegging, they have to follow the center or base country to maintain the peg. And remember that this is a rationale that follows from UIP. UIP means that there's no arbitrage possible. Otherwise, there would be profit opportunities to be made. This is very important. Why UIP implies that interest rates should be equalized, as the expected depreciation is zero if the peg, the fixed exchange rate, is credible. That is because we assume here implicitly that we have free capital flows. What this means is that there should be no arbitrage, and the no arbitrage condition is defined by UIP. We assume free capital flows. If we have capital controls, there could be arbitrage profit opportunities to be available, but if you have a limit set by the state, the regulator, the government, where you cannot take advantage of the existing arbitrage profit opportunities, UIP does not hold. So that's why it is important to keep in mind that so far this discussion has assumed that UIP is true and holds between countries that have free capital flows. So moving on to the third bullet point, the non-center country loses its ability to conduct stabilization policy, but the center country keeps that power. So the non-center country loses and the center keeps that power. And this is called the nth currency problem. Sometimes also called the exorbitant privilege of the center country. This exorbitant privilege is often used and in a slightly related but not identical topic of the special status of the US dollar as the reserve currency of the world and the main trade invoicing currency of the world. This is something else, and you can look this up. US dollar reserve currency exorbitant privilege. to read up on this very interesting related problem in the international financial system. So there is a non-cooperative as well as a cooperative way to exchange rate adjustments under a fixed exchange rate regime. And non-cooperative solutions would be beggar thy neighbor policies, which improves one country's position at the expense of the other country. And this could sometimes lead to tit for tat. And one can see similar, if you like, results and reasonings and rationales in the trade war tariff topic, where there's one country trying to gain at the expense of another country. And this, if you consider it in a dynamic game theoretical framework, could trigger a counter reaction, an adverse counter reaction from the counterparty, from the other country, that needs to be taken into account to evaluate the medium to long run effects of any beggar thy neighbor policy, which often has short run gains, but not necessarily medium or long run gains. The details of the cooperative versus the non cooperative adjustments I have left to be studied by yourself in consultation with the textbook, which provides detailed graphs on this topic of cooperative versus non cooperative solutions. But the details, I would say, are not essential. Rather, the more important thing that we will talk about next is the trilemma, which is an extremely important and interesting concept in international finance. So, as explained previously, the gold standard is a system via which there is no center country, and all countries are indirectly at a peg when you convert your currency to gold and then convert from gold to another currency. You have an implied exchange rate without any center country. For instance, imagine you have two countries, Britain pegging gold at P bar G, and France at P bar star G. At £1 cost, 1 divided by P bar G ounces of gold. Each ounce of gold costs P bar G francs. And this is due to the fixed gold price set by the central bank in each country. A pound costs E bar par equals P star bar G divided by P bar G francs. And this ratio is defined by the at par exchange rate implied by the gold prices in each country. And this gold standard is dependent upon the free convertibility, which means that the central bank is standing ready to buy and sell gold at the announced rate of exchange between gold and your home currency. So your home currency, let's say if you're in the United States, the Fed would say we will exchange $1 for so and so many ounces. And in China, the renmin, Zhongguo Yinhang, the Chinese central bank, would say we stand ready to buy so and so many renminbi in exchange for so and so many ounces of gold. And this free convertibility means that at these mint prices, the export and import of gold, the international trade of gold, is unrestricted. So the model suggests that the trade volume and economic transactions will improve when you have a fixed exchange rate. Again, note the caveat that I've mentioned on previous slides, that this could be a correlation driven by perhaps, if you like, a reverse causality, namely that the countries that are, if you like, increasingly trading with one another and are engaging with one another economically, they might be prompted to adopt a gold standard rather than vice versa, rather than the gold standard being the cause of the increased trade. Could be that the volume of trade is a precedent, a precursor to the adoption of the gold standards. In the 19th century, then, it is likely that countries crossed the fixed line to adopt a fixed exchange rate and met the criteria for having net benefits of fixing. And as mentioned on the slides, there were a lot of other forces at work encouraging a switch to the gold peg before 1914. But over time, by the 1930s, world trade has fallen, and the rationale for fixing, based on gains from trade, was slowly weakened, suggesting that using the gold standard as a exchange rate regime was becoming more and more less attractive to countries. Very briefly, this is the last main and important topic. This is the policy trilemma. On the edges of the triangle are the policy choices. You have to pick one corner. So if you're in one corner, the sides of that corner, say goal 1, goal 2, can be obtained, but the other objective cannot be obtained. For instance, if you would be in this corner of the triangle. So you can achieve policy goal 1, you can achieve policy goal 2, but not policy goal 3, because you can only satisfy this side and this side of the triangle, but not all sides of the triangle at once. And this is the idea of the trilemma. You can be in this corner, A, in this corner, B, or in this corner, C. And in each case, you have to give up one of the goals. Policy goal 1 being fixed exchange rate, goal 2, free capital flows, capability, and goal 3, monetary policy autonomy. And if you have a fixed exchange rate regime, this is no monetary policy autonomy, because on the left hand side you have a fixed exchange rate on side, if you like, side 1, and on the right hand side you have policy goal 2, capability. If you want to have free capital flows, it would imply that you have no longer monetary policy autonomy. And this is what we have implied with UIP, that you have carbon mobility and a fixed exchange rate, and the result is no monetary policy autonomy. And you can examine each of the corners of the triangle and then see which goal you need to give up.